Okay, let's go ahead and go through the intercompany bond transaction examples they're on Angel. Okay, so the first example, we have a partial retirement. Assume that on January 1st, 2010, big company issues $1 million of 10% 10-year bonds at 103. The bonds pay interest every year at 12/31, and on 12/31/15, 6 years later, little company buys 800,000 of these bonds on the open market at 102, and we need the elimination entries for 2015, 2016, and 2017. And again, the first thing we have to do is figure out what's the book value at the date of acquisition so we can figure out the gain or loss. The face value is $800,000. The remaining premium is $9,600. Again, these bonds originally had a 3% premium, so 3% of $800,000 is $24,000. That was being amortized over a 10-year life, and 6 of those 10 years have elapsed. 4 of the 10 years, or 40%, still remains. So 40% of the original $24,000 is $9,600. And so they've got a book value or carrying value of $809,600. They were bought for $816,000 in face value plus 2%, and so there's a loss on retirement of $6,400. Now let's go ahead and see what's on the ledgers for these two companies at the end of 2015. Again, this is the year of acquisition. On the issuer's balance sheet, big, on their ledger, they've got bonds payable of $800,000. They've got their premium of $9,600, and they don't have any interest expense. This, again, what we're trying to lay out here is the intercompany accounts. Since the bonds weren't purchased by the affiliated entity until the end of the year, there's no intercompany interest this year. So big company simply has the bonds payable and the premium. And again, all we're concerned with are the intercompany bonds. Big company's total bonds are $1 million, but again, we're only concerned with the portion that were bought by the related party. Little, the bond buyer, has investment in bonds $816,000. And so their elimination entry, again, we're simply going to eliminate those three accounts. So we eliminate the bonds payable, we eliminate the remaining premium on bonds, and we eliminate the investment in bonds, and we go ahead and record that $6,400 loss on sale that, again, has been realized but not recognized previously. If we're going to do the equity method entries under the full equity method, again, there's a $6,400 debit or loss on the income statement, which means we need to show a $6,400 debit or loss under investment income. Since this was downstream, we report 100% of that $6,400 loss. Okay, let's go ahead and go on to year 2. For 2016, again, let's make our list of the accounts on the ledgers. The bonds payable, balance of $800,000 still. The premium on bonds is being amortized. Again, last year it was $9,600, and that represented the remaining 4 years of these bonds' life. That was $2,400 per year for 4 years. One of those years has elapsed, so the premium has dropped to 3 years at $2,400 per year. And now they do have interest expense. They've got interest expense. Their coupon interest, 800,000 times 10% is 80,000, less the premium amortization of 2,400. Over on Little, the buyer's books, their investment in bonds is dropping because, again, that premium is being amortized. They originally bought it at $816,000, a $16,000 premium. The bonds had 4 years left to run, so that premium was being amortized at the rate of $4,000 per year. So it was $816 last year, it's $812 now, and their interest revenue, again, is the coupon interest of $80,000 less the amortization of that premium of $4,000 for $76,000. And so for our elimination, again, we're going to eliminate all 5 of those ledger accounts that represent the intercompany bond relationship. So we eliminate the bonds payable and the premium on bonds. We eliminate the interest expense, so we've taken all of Big's stuff off their ledger. We eliminate the interest revenue and the investment in bonds from Little's books, and we carry forward that the realized but unrecognized loss that we had last year. Since this is an upstream transaction, we don't share it with a non-controlling interest. And since we're using the full equity method, we debit investment in Little rather than retained earnings. Over under the equity method, if you look at that elimination entry, there is a debit to interest revenue for $76,000, a credit to interest expense for $77,600. So if you net those two income statement accounts together, you get a $1,600 net credit. So in the elimination entry, there's a $1,600 net credit to income. So under the equity method, there's a $1,600 credit to investment income. Okay, finally, one more year. And again, as before, we list the ledger accounts we've got. On BIG, the issuer's books, they've still got their bonds payable. The premium on bonds payable has dropped by another $2,400, and their interest expense is $77,600 again. On Little, the buyer's books, their investment in bonds has dropped by another $4,000. Again, it was initially $816, then it was $812, now it's $808. And their interest revenue is $76,000 even. So for the elimination entry, just as before, we eliminate those 5 accounts for Big and Little's books, and we carry forward the $4,800 remaining realized but unrecognized loss on sale. Under the equity method, again, we've got in the elimination entry, we've got a net $1,600 credit to the income statement in the elimination entry, which means we have a $1,600 credit to investment income. Okay, the next example from the bond examples. Oh, that's pretty tedious. Okay, now we've got a mid-year retirement. Assume that on January 1st, 2010, Little issues $1 million of 10% 10-year bonds at 96. The bonds pay interest annually every December 31st, and on 10/1/14, so 10, 11, 12, 13, 4 years and 9 months into the bond issue, Big company comes along and buys all these bonds on the open market at $9.58. And again, we need to do the elimination entries for 2014, 2015, and 2016. And remember, from the very beginning of this example sheet, Little is an 80% owned subsidiary. And that's going to be important here because, again, Little was the bond issuer, so this is going to be viewed as an upstream transaction. Again, first thing we have to do is the book value at acquisition. Face value is easy, $1 million. The remaining discount. Again, these bonds initially had a $40,000 discount. Over 10 years, that would be amortization of $4,000 per year. And again, we had amortization for 2010, 2011, 2012, 2013, plus 9 months, or 9/12ths, or 3/4ths of 2014. So we've taken amortization for 4 full years, plus 3/4. So we've amortized 19 out of the 40,000, 4,000 plus 4,000 plus 4,000 plus 3,000, which means there's $21,000 left, for a book value of $979,000. They were bought for $958,000, a savings of about $21,000, and so there's our gain. And it's just an unfortunate coincidence that the gain equals the remaining discount at the date of acquisition. Now again, the $42,000 discount on the bond purchase that's on the buyer's books, Big's books, is going to be amortized at the rate of $8,000 per year. Again, from the date of acquisition, these bonds have 5 1/4 years left to run. So 42,000 divided by 5 1/4 is $8,000 per year. And again, let's look at the ledger accounts for 2014, the year of purchase. On Little, the issuer's books, again, this is the end-of-year ledger balances. Bonds payable $1 million, that's straightforward. The discount on bonds is now down to $20,000. It was $21,000 on October 1st, the date of acquisition. Now it's down to $20,000 because, again, we're amortized $4,000 per year, or $1,000 per quarter. And they've got intercompany interest expense of $26,000. Again, we're looking for 3 months worth of interest expense. These bonds were only an intercompany issue for October, November, and December. So we're looking for 3 months of coupon interest, $25,000, plus 1 month of discount amortization, or $1,000, for a total of $26,000. Over on Big the Buyer's books, their investment in bonds has risen to $960,000. Again, it was being amortized at the rate of $8,000 per year, and so we would have taken 3 months, or 1/4 of a year's worth of amortization, or $2,000. So again, the initial cost was $958. We amortized $2,000 of the discount, taking us up to $960. Their interest revenue, again for 3 months, $25,000 of coupon interest, plus $2,000 of discount amortization. So the elimination entry, as before, now we're just going to go through, we've got 5 ledger accounts there, 3 for little and 2 for big, and we simply need to eliminate all of them. So we eliminate bonds payable, we eliminate the discount, we eliminate the interest expense, we eliminate the investment in bonds, we eliminate the interest revenue, and to make this thing balance, we need our $21,000 gain on retirement of bonds. Under the equity method, again, if you look at that elimination entry, we have a debit to interest revenue, a credit to interest expense, and a credit to gain on retirement of bonds. If you net all those things together, the net credit is $20,000. And so under the equity method, we're going to credit investment income for our share of that $20,000. Again, this is now an upstream transaction, so we get 80% of that. Now, how much of a gain are we going to carry forward to next year? Initially, there was a $21,000 realized but unrecognized gain, of which $1,000 was recognized via the disparate interest revenue and interest expense on Big and Little's books. So we're going to carry forward $20,000 to the following year. So let's see what happens in the following year. In 2015, again, we need to make a list of our ledger accounts. Little the issuer has their bonds payable. Their discount is dropping further. Again, last year was $20,000. Now it's down to $16,000 because it's being amortized at $4,000 per year. Interest expense, now we've got a full year's worth of intercompany interest. $100,000 coupon interest plus $4,000 of discount amortization. Over on Big the Buyer's books, their investment in bonds is up to $968. Remember that they had a discount of $42,000 initially when they bought it, being amortized over 5 1/4 years, or $8,000 per year. So we went from $958 to $960, and now we're up to $968. Next year it'll be $976, and so on. Their interest revenue, again, the coupon interest plus the discount amortization. So as before, for the elimination entry, we need to eliminate these ledger accounts. We eliminate Little's accounts, we eliminate Big's accounts, and now we need to carry forward that $20,000 realized but unrecognized gain from the previous year. Since that was an upstream transaction, we're going to split that $20,000 between the investment in Little and the non-controlling interest. Under the equity method again, we look at that elimination entry, and the two income statement accounts are interest revenue and interest expense. They've got a net debit between them of $4,000, and so since there's a $4,000 debit to the elimination entry, we do 80% of that, or $3,200, as a debit to our investment income. Okay, let's go on to the last year, and it'll be the same drill as before. We make a list of, and again, keeping T accounts for the discount and so on would be a big help here. We list the ledger accounts for Little the issuer and Big the buyer, and again, the bonds payable is staying the same. The discount is being amortized, so it's dropping by $4,000 per year. Interest expenses, straight line amortization, so it's a constant $104,000 per year. Over on Big the buyer's books, their investment in bonds is rising by $8,000 per year as their discount gets amortized, and their interest revenue is constant because of straight line amortization. And so again, we eliminate all of the ledger accounts for Big and Little, and now we're carrying forward $16,000 from the previous year, and again, since it's upstream, we share it between the investment in Little and the non-controlling interest. And the equity method entry, same as it was the previous year. Okay, one last example for the bond issuance. And now we're going to do this, we're going to make it a little bit more fun, or a little more interesting, or a little more time-consuming. Let's go ahead and have another bond issue. It'll be a 100% bond issue, 100% purchase, but let's go ahead and use the effective interest method just to review. So on 1/1/10, Little issues $1 million of 10% 10-year bonds. The bonds pay interest annually. The bonds are sold to yield 12%, so they're going to sell at a discount. A few years later, 3 years later, on January 1st, 13, Big is going to buy all these bonds at a yield of 8%. So they're going to buy them at a premium. Again, the bonds pay 10%. They're going to buy them to yield 8%. So they're going to be bought at a premium. Okay, first thing we have to do is figure out the issue price. So again, back on January 1st, 2010, what is the present value of those cash flows discounted at 12%, the yield when they were sold? The present value of the interest plus the present value of the principal gives us a total present value of $88,699.55. And again, this was what bonds were issued for when Little issued them back on January 1st, 2010. And we're going to need an amortization table. So there's our amortization table for these bonds. Again, we start with the beginning of year carrying value, multiply that by the effective rate to get interest expense, subtract the cash interest to get our amortization. So then the following year, 2011, we update the carrying value because of that amortization. Again, in 2010, we had $643.95 of amortization, and so we should be moving closer to our face value. So we're moving from $88,699 up to $89,343. Again, the amortization should be moving us towards face value, not away. So if you had subtracted the $643 and ended up with a 2011 carrying value of $88,000 and whatever that is, $56, that would be wrong. You need to be moving up towards $100,000. Now, Big Company bought the bonds on January 1st, 13 at a yield of 8%. So again, we need these bonds at that time. These bonds have 7 years left to run, and we need to calculate what was the present value of these bonds. What's the market price of these bonds discounted at 8%? So again, the present value of the interest, and now again, the interest is a 7-payment annuity. There's only 7 years left. Present value of the principal. So total present value of $110,412.74. Again, we expected them to be bought back at a premium because the market rate, the yield rate, the effective rate is less than the coupon or stated rate. And again, we need another amortization table. And again, the explanation is exactly as it was before. In this case, just to refresh our memories, in 2013, we had a carrying value of $110,412.74. Effective rate of 8%, so interest revenue is $88.33. Subtract the cash interest, so the amortization is a negative $1166.98. And again, that negative means that when we get the carrying value for the next year, we want to subtract the amount of the amortization from the previous carrying value. So the carrying value goes from $110,412 in 2013 to $109,245.76. In 76 cents in 2014. Again, we should be moving down towards the face value. Where are they? There they are. Okay, just to refresh, we're going to need this data, so I've copied the amortization tables. The upper one is for the bond issuer, the lower one is for the bond buyer. Now on the date of purchase, again, the bonds had a carrying value on the issuer's books of $90,872.49. Looking at the top amortization table, if you look at the 2013 row, the 1/1 carrying value is $90,872.49. They were bought back for $110,412, a loss of $19,540.25. Again, let's make a list of the accounts on the issuer's books at the end of 2013. Bonds payable is easy. That's the bonds payable, $100,000. The discount on bonds. Now again, looking at the top amortization table, the carrying value numbers represent the carrying value at the beginning of the year, face value minus discount. So to get the end of 2013 discount, in this case, we need to look at the beginning of 2014 carrying value. So at the beginning of 2014, which again is essentially the same as the end of 2013, the carrying value was $91,777.19, which implies a discount of $9,222.81. I'm sorry, $8,222.81. And Little has interest expense. Again, now we look at the 2013 row of the amortization table, and we see interest expense of $10,904.7. On Big the Buyer's books, they've got investment in bonds, $109,245.76. And again, that's the January 1st, 2014 carrying value, which is again the same as the end of 2013 carrying value. And they've got interest revenue from the 2013 line of the amortization table of $88.33.02. So again, in the elimination entry, we need to eliminate these 5 ledger accounts. What's missing on the credit side is that on the debit side is the loss on retirement of $19,540.25.